Hey guys, we're live with the commodity report today, and waiting for Kevin and possibly Sam Gatlin coming in as well. Um, but I just kind of wanted to get you guys started the recent performance. So we haven't been with you for a bit. So I had a event in Chicago last week where we went over bond market, the commodity market, and the cycles of the market. It was a lot of fun at the Portfolio Accelerator for Stock Market TV or All Star Charts in Chicago recently. Going over the month-to-date performance, surprise, surprise. Kevin and I have been talking about this one for a while, and that's natural gas. Natural gas is leading the way up 20%. So we had a 20% gain month-to-date in natural gas. We aren't even nearly finished with September just yet. Getting close, but we're not quite there. Sugar right behind that. If you've been a part of the group, you saw us try to catch a bottom signal on that one. Got the bottom signal, also then got a false breakdown signal. So sugar is up 15% in the month. Oats right after that up 11%. Palladium, and it was up even more than this at one point. I think it hit about 15, 16% at one point. Now it's pulled back a little bit, up 9%, basically 9.5% for the month to date. Coffee right behind that, up 6%, wheat behind that up 5%. And so we're seeing this kind of shift into these softs, into the grains that we haven't seen for a while. And so it's interesting to see that something that we haven't seen in this market for a while is finally starting to happen. We're starting to see breadth in the commodities market. We're starting to see certain areas of the commodities market start to move that we haven't seen move in quite some time. So this is going to be a really interesting market. Hopefully the commodities just keep moving. 1 second. Oh, forgot to send Kevin a link. That's my bad, guys. 1 second. Just got back from a trip, so bear with me, guys. So Kevin's about to come on. But I just also wanted to go through a little bit of the slides today. We had some interesting slides that I got to go through, and here we cover the commodities market. I wanted to just show you guys a couple things on the commodity cycle, things that we've been seeing in this market recently. So the first one is a chart from Cadusa. So don't know how exactly to say that name. Haven't heard it said out loud. But their research is really good. I've always enjoyed their charts that they put out. And this one, they continue to update, which as we look at the S&P commodity index to the S&P 500, see, commodities are incredibly cheap today. And the thing I like to say is commodities tend to bottom not as quickly as stocks do. Stocks, as you can see there, they bottom very quickly. Next thing you know, they're reversing in direction. So this is a really good chart to just kind of show you guys where we are in the commodity cycle. Are we at a situation where the commodity cycle is cheap? Is it buyable? Are we ready to continue to move higher here? And to me, I think that there's a lot of reasons to think the answer is yes. At the moment, we're looking at the commodity cycle through the lens of what's going on with the Fed, how much liquidity is in this market. And so as we're looking at it in that way, we can kind of see that, oh, morning, Stefan. I love that. Love getting great comments from you guys. So please feel free to comment anytime. But when we're looking at this cycle here, we're kind of seeing that we do have an opportunity to move higher here in the market. And so we can absolutely see a commodity bull run happening again. Just double checking, making sure Kevin got the link. Okay, Kevin's got the link. Then the next chart is from Ned Davis. I shared this one at the event as well. I wanted to share it with you guys as well. So, you could see the full presentation at Portfolio Accelerator. I actually went through everything in the commodity cycle, from the manipulation behind the bond market, not manipulation as in stock manipulation or bond manipulation to get buyers to continue to always think bonds are the place to be, even if it's a cycle where bonds are not the place to be. And so, as we're looking at this chart, this is kind of just where we're at in the cycle currently. This is a chart from Ned Davis. We recently remade this chart. Grant remade it at All Star Charts, but looking at this chart, just kind of showing where we're at in the cycle, where we could be at, and what we could see going forward. And then the next chart is up here. And so I'll pass this to Kevin in a second. But looking at this chart, I really just wanted to kind of highlight what we're seeing here. Like, are we seeing a full-on like a dot-com bubble bust and then a inflationary crisis, or are we just seeing that the commodity cycle is picking back up again? And my idea is that we're seeing that the commodity cycle, the long-term commodity cycle, is kind of picking back up again. But now Kevin's here, so I want to hear what Kevin's been seeing in the market this week. So what's up, Kevin? Sorry about that. I for some reason thought I sent you a link. I guess I didn't. You're on mute, Kevin. Or wait, maybe. Let's see. Yeah, it says we don't have a...
All right, can you hear me?
I can hear you now. Okay, you're good.
Okay, yeah, sorry about that. And unfortunately, I will have to jump in about probably like 3 minutes or 4 minutes. Can you restate that question one more time, though?
So I was just seeing what you were doing and looking at in the market right now, natural gas especially. And then when you get back on, we can kind of get into your last report on uranium.
Yeah, look, so natural gas is the time right now for kind of that seasonality period to kind of take place. So we are seeing a nice little rocket to the upside here. There's also a little bit of I would say a little bit of a concern from geopolitical risk out there, not because of the Israel Lebanon situation now, but also what's happening between the Ukraine and Russia, and that could also have a little bit of a disruption when it comes to flows in general, and then also potentially the targeting of certain ports out there could also be elevating, for the most part, a lot of these commodities. So right now we are seeing a nice little pop to the upside. I'm not sure when it's gonna, how long it's going to last. I mean, a 15-cent move just today is actually pretty remarkable. I would look at this first area support at $2.75. Natural gas, yeah, has definitely moved, and it has been a mover and can continue to be one. Just kind of note too, once you and I kind of talk about that, I feel like the seasonality is going to be probably one of the bigger factors as we kind of start adjusting our weather forecast models for the winter and the potential draw that we could see from the EU.
What's up, Sam?
What's up? That natural gas looks so good. 6% today, guys. Is that what I'm seeing?
Yes.
Yep.
Wow.
It's a mover, and I think that's a thing that Kevin and I were continuing to talk about this, and it's when this thing moves, it really can move, and it can go for very quickly. It can make jumps like you can't believe, but also you have to understand that it can do it the other way. So, I'm excited to be long it. We're all long it. We had that we had a reversal signal on it, which has been great. But at the same time, you got to be careful about your position sizing, and you might get really happy. I mean, some people get really happy it's going up, and they're like, "I'm going to add to the position, add to the position, add to the position." But it's natural gas; it could be up 6% today, it could be down 7% tomorrow. You never know.
So you position it pretty close to like how you treat Bitcoin.
Yes, so that was one thing we talked about at the portfolio accelerator was how would you size that position for something like natural gas, and the answer for me is I would size it very similar to Bitcoin. It has the same type of volatility as something like Bitcoin, actually a little bit less than Bitcoin. So people think they call natural gas the widow maker, but they don't ever talk about Bitcoin being a widow maker, which there's plenty of times where Bitcoin can be the widow maker. So once again, I really do like the idea of just going, okay, I'm going to have a little bit of smaller position here because I don't know where this thing can end up. So Kevin, before you go, so what are you thinking? Where's a target for natural gas that we could let our people know about? What are you thinking there?
Well, I mean, from a technical standpoint, I would look at 275 being a key area of resistance. I gotta find it. This does look like a news move. And I don't know what the news is. Maybe there's an adjustment when it comes to earnings expectations for a company or something of that nature, but a pretty strong spike that we saw there. So I'm not sure exactly for the full reason why we are seeing it, but I would say 275 would be your first key area of resistance to be to be mindful of. Once you start getting to around that 290-ish, that's when it gets a little bit extended. But once again, we have that seasonality or that winter that's coming here. So, that could be a very strong driver until those factors kind of dissipate. So that's kind of what I'm looking at from a technical standpoint, but a really nice move after kind of that consolidation, compression, breakout scenario.
So another thing, so do you have to go, Kevin? Or you got a sec?
I will, I'll just jump whenever I can. So go ahead.
Okay. So wheat, that's another question I want to ask for you. So wheat, we're seeing the grains, and the first thing I opened this up with was the performance month to date. As we go over the performance month to date, we're seeing natural gas number 1, sugar number 2, and right behind silver is wheat and then cotton. And so we're seeing things like oats, sugar, wheat, cotton, back into that leaderboard again, which we haven't seen for a long time. So are you seeing anything in the grain market that's saying, hey, this is possibly bottoming now, finally?
So with wheat right now, what is taking place is obviously we have a little bit of a harvest here in the United States. And then there is the readjustment of expectations of production from Russia, Ukraine, and I believe wasn't Argentina. I'll have to get the last country. And then there's also the fear of disruptions of Black Sea shipments. So that's one of the reasons why we're seeing kind of a little bit of a pop for wheat. I would go towards the fact that we're looking at, and I do have to jump here. So it's more of like a readjustment when it comes to the expectations. I'm going to jump. I will be right back, and I'll jump into that a little bit more here. Sorry about this, guys.
No problem, Kevin. I'll see you soon.
Yep, I'll be right back on it.
And so Sam will just take that over. So Sam, give your fundamental analysis on wheat. I'm just kidding. But what are you seeing on the chart, Sam? I'll pull up a chart of wheat. What are you seeing level wise? What should people look out for? Do you think it's in an uptrend again, or where would that be where you would see an uptrend for wheat?
Yeah, for me, this pivot high was a big one from May. If you can get back above that, I'd be interested. Right now we're battling with the anchored VWAP from that same May pivot high, but you had a good run into that. So from March to May, it looks like you rallied about 40%. So that was a pretty good rally. Did you get buy signals back in March?
Yeah, so we did get buy signals back in March already. So that's something that's been quite interesting, is to kind of look at wheat. We're seeing we got a bottoming signal. So that false breakdown signal was the first one we got. But now we're starting to see like this, we're starting to hit a 50-day high. And if we're seeing this 50-day high, this thing could be trending here, and a trend could be starting. So I think that's something that people really need to continue to look out for. Some reason it's not letting me put this in a full screen, but let's see if this is good enough. But if you're looking at wheat here, we're seeing that 50-day high. So that red line is a 50-day high. So we've blasted right through that, closed up there, which is also a really good sign of a trend change. Now, once again, this could be just another possibility for a trend change. But if we put the real signal where it's going to be, hey, this is a real trend change, this is something that's happening here that we haven't seen for a while, is going to happen probably around a 100-day high or a 20-week high. So if we're looking at this is the 20-week high signal. That isn't anywhere near us right now. That's all the way back up at those old highs that you were just talking about, Sam, from May. So
yeah,
if we get
exactly.
over that,
yeah, that's an important level, and I think it's going to take some time. Like, you've gotten a weekly MACD buy signal, and you're really close to that monthly MACD buy signal, and that's been working really well recently. Like, look at palladium. We recently got that monthly MACD buy signal, and
palladium was a great
it hasn't been messing around down here. That thing has been ripping.
No, and that's very true, and that's one that we've been talking about like crazy. So Sam's been posted that signal in palladium recently. So let's take a look at that. So if we look at palladium, So Kevin and I talked about this, the false breakdown signal and the positioning that was insane. And so we basically got the false breakdown signal, bought it. And then Sam, you were pretty adamant on the fact that this thing could move even further. And then this was right around here. So this is basically pulls back to that kind of breakout zone. It bounces off of that breakout zone and it continues. And it hasn't looked back yet. Yes, like it's once again, it's very similar to something like if you're looking at something like natural gas or Bitcoin, like the volatility is going to be very high. Not to mention the futures contracts. These futures contracts are huge. And because these futures contracts are so big, you're going to be like, oh my gosh, like, we're down 5%. And that means 5% is about $5,000 per contract. Even more, actually, I think it's 7,000. So, I mean, it's a huge contract. So be careful if you are trading the futures space.
The ETF is pretty good too.
Yeah, so the ETF is kind of what Sam and I would recommend if you are a person who doesn't have the amount of funds to trade something like futures. You definitely could trade the ETF. I don't know how liquid the options are. I don't think you need options for something like this where the moves are 5% a day. I mean, look at that candle from the last week. I mean, that was amazing. So I mean, we had a 15% week last week. Huge move there. So I really
this
do
chart
like
just kind of screams leaps to me. It's like buy 2-year call options or something like that.
I don't think are the options on it very liquid, Sam?
On like the PAL ETF.
Yeah, on the
Or
PAL.
you could even do it for the commodity though.
For the commodity, yes,
Yeah.
they're okay, but there's still a little bit of liquid even for that. But if you did buy 2-year leaps, it would be one way to take advantage of that. But I really do like this one. This is a great.
That's just like what the chart pattern says to me.
Yes. So if we look at another thing, Sam, which is copper, so HG. So if we're looking at copper, that's another one I really like the look of right now. So copper finally breaking out of this zone. So it made a higher low, reversed. And if you really look at it like primary trend style indicators, we look at primary trend indicators. That's one of my favorite things to look at. It's just 52 weeks highs, 52-week lows. We're still holding the primary trend. And then if we go a little bit closer, we hit a 100-day low. So we hit a 100-day low, but we reversed quickly off of that. That tells me something because a lot of these quantitative trend following systems, they trade without, like any human intervention, completely detached from being discretionary. And most of the time they're going to sell at that point. And when you see sellers come in at a 100-day low and then it reverses higher off of that, most of the time that's going to tell you something. It's going to tell you that all that trend following, all those quantitative traders, they couldn't pull the market any lower. And so now we're seeing a reverse higher. It's the same thing if you look at a 50-day low, 100-day low, or a 52-week low. If it bounces off of those levels, that usually tells you that the bottom is very close. And so we reverse higher off of that point, and we break out over. So secondly, we have a higher low. So we got a higher low right there, and then we break out over this zone. So to me, I really like the look of it. I always like to look at things in a closing level. So closing levels, we're closing above those areas. This still looks really good. What are you thinking about copper, Sam?
For me, the SCCO, can you pull that chart up?
Yep.
So this is one of the biggest copper miners in the world. This is $83 billion. But I think if it's scooping back above, you'll see it here in a second. Go to a daily chart.
Yep.
There's a big level there, but I think this is great information for copper. If you want to be a copper bull, if you can scoop back above those April lows and the June lows.
So scooping back above the April lows, the June lows, nice reversal here. Getting basically above 106, you'd say it's a buy.
Right. This would be my preferred vehicle over copper futures. It's a little bit cleaner of a chart, but
much cleaner. Well, I'd say it's different. Yes, but there isn't a higher low on it. The copper is showing a little bit of relative strength at the moment. So the new high is above the old highs from the summer. So there is something there. But if we look at it just like this, then we could go, okay, like 106. Sam saying it's a buy. I completely agree with that. And so I'd be on the outlook for buy signals in SCCO in copper. I mean that's very interesting, Sam, and something to kind of think about for everybody out there, which is, everybody's going, and it's the same thing we talked about this week. Your commodities are dead. Commodities look terrible. Commodities are dead. Can't be buying these terrible products that everybody keeps talking about. But at the same time, Sam and I look at this market day after day. And when you look at it all the time, you're seeing that there's areas of strength here. And the biggest thing that's going to tell us a little bit more about that is when you're looking at something like copper or a copper miner, and you're looking at those things and going, okay, well, here's copper, here's a copper miner, and it's showing relative strength to the market. It's showing that the market came under pressure the other week, and copper was really up most days. So all of those things together are telling me, hey, is this more of a growth cycle that we're coming into here? But also something that always kind of gives me a hint about the winter. So I always like to say, I love to trade after the elections. But really what gives me the best hint about what's going to happen in the market is looking at things like copper, looking at things like Bitcoin, looking at where growth is actually coming from. So if we go even to a chart of
how much does steel mean to you in that calculation?
Steel, not much.
Like steel and coal look not good, really.
Yeah, so steel looks, but if you look at even the XME, which has a lot of copper miners in there as well. If you look at the XME, that's a choppy chart up close, but if you go further out, you zoom out. Sorry, this was a candle chart that got changed over, so it's going to look messy. But if we go further out, we definitely see that we're seeing some relative strength kind of come back into these areas. But for me, the metals and mining, the idea of steel, all those things can be manipulated to some major degrees. So I kind of go, okay, I'm going to take it with a grain of salt. Copper is always my biggest indicator that I'm going to look at. Sorry, guys, I was looking at the chart like I had it on the screen. Sam's much better at this. Sorry about that, guys. But if you're looking at it and you're going, okay, well, steel has to move up because copper's moving up, or growth in the world, or lumber has to move up. A lot of these are very sensitive to economic data. And so because they're so sensitive to economic data, you're going to see them only move at certain times, and certain times in the cycle. And so I think that an idea here is to continue to look at them, pay attention, but copper is going to be your main signal to tell you when you need to get in or out of the market.
I think home builders are a big part of that equation as well. Like home builders, they trade pretty closely with like industrial stocks. So I would say home builders and industrials also have a lot of economic information in them, more so than looking at technology stocks.
Yes. So, I mean, the home build to me is, if the home builders continue to make, I mean, look at that chart. It's ridiculous. If the home builders continue to make new highs and they continue to run this way, how in the hell can you be bearish on the market? Like it's impossible for me. Like I really I mean, and once again, I'm not saying like black swans don't happen and this doesn't happen, or something like, the Fed's cutting rates, maybe it could be bearish, or coming out of yield curve inversion. Sure, there's a million reasons I can make up to be bearish here, but
you can't short all-time highs though.
Yes, you cannot short all-time highs, and you can't, like, there's old books, and you'd see people go, well, if you look at Paul Tudor Jones, he says he sells at new highs, and it's a difference when you're running billions of dollars. You have to sell into liquidity to make money. So once again, like, you can't just sell all the time. If there's no liquidity, you're going to get stuck in positions. So they have to do things in a different way. So you have to always consider the source. But if we're trend following, if we're trying to just ride trends, make new highs, continue to move higher, as a trader, I want to be long things as long as they're moving up. I want to be short things when they're moving down. And how do you do that? Well, you just follow the trends. And yes, I get it. It's scary. Like, look at this chart. Like, nobody wants to go, Oh, I'm up. Let's actually put it from our signal. So the breakout signal is back here. You know, you get 100% move. People don't want to go, okay, I want to sell that, you know, I want to stay long that thing that's already moved 100%, or I want to buy that thing that has already moved 100%. But you got to do the opposite with what most people do as traders. Most people go, okay, this is falling, I'm going to buy that. So that this area is falling, I'm going to buy it. Nobody wants to buy new highs though, but that's how you make money.
Yeah, it is.
You
That's how
gotta
you make
follow
money
the
on the
trend.
short side too.
Yes,
You
you got to
wait
make money
for
in the
the trend to
trends.
reverse, and you don't short the all-time highs.
Absolutely not. And so even biotechs, you know, we're looking at this one
Yeah,
and this one.
biotechs. They look so good here, Jason.
Yes.
And
So
if
why
you're
don't you
bullish biotech, you got to be bullish small caps, just in general, right?
why don't you talk a little bit about that, Sam? Because you had a biotech presentation that you were doing. So what are you seeing in the biotech space? You know, you were showing a bunch of really good charts that had a lot of room to run. So what are you seeing in the biotech space?
Yeah, man. So we were here several months ago saying biotech looks so good. It looks ready to break out and complete this bearish to bullish reversal pattern. We were ready to buy, but when you went chart by chart, you didn't really see really good structures there, really good individual stocks that you wanted to buy. But that's different today, Jason. I can bring you a deck of 30 different biotechs that are completing massive reversal patterns, and I think it could be for real this time.
No, I
And at the
agree.
end of the year, I think there could be some massive moves from these biotechs.
Sam's
Talking
doing
like
some
doubles,
great research.
triples.
I'm excited about your research on this, and I think it's an area that, like, once again, if you're a trader, you're looking for these big moves, quick moves, it's the place you want to be. So I'm excited to see that product as it comes out. So Kevin, let's get back to natural gas. So I
want to
a lot of people
apologize.
don't know. Like, hold on real fast. Like, let's appreciate Kevin's dedication, because Kevin's, you know, he's got his job at Schwab. He's busy doing stuff, but he always comes on and tries to do his best in the middle of his busy workday. So I appreciate that a ton.
You're the man, Kevin.
Dude, well, let me just say, I am just not having a good day. My Monday is going horribly. So I do apologize for that. And I appreciate the kind words. So let me try to reset here. So wheat is catching a bid. It has been catching a bid. There is a little bit of a concern that Russian production forecast for next year is going to be reset to the downside. We also have some moisture or precipitation hitting some of the major areas here in the United States. And so when we look at wheat can be harvested or basically planted and harvested about 3 times a year, right? We pretty much, for the most part, have wheat growing all year round. Now, when you're looking at Chicago wheat, you have a little bit of a lull when it comes to December, but that's when Minneapolis wheat, which is something that we don't export, really starts to thrive. And that's what everybody really kind of focuses on. But the wheat complex right now, I don't think this is a confirmed breakout. I think this is more weather, and then also looking at production levels moving forward more than anything. We still want to also see demand actually spiking to the upside. Now, if we kind of look at it from a longer term time frame, as well as the Fed rate cuts that we just saw, right, we should hopefully still see the dollar kind of sliding to the downside. If that's going to be the case, the prices for our goods, especially when you're looking at agricultural products, should actually get cheaper and cheaper theoretically. Then that should also boost export demand. If we have a boost in export demand going up, and that's where we would actually start seeing a stabilization and a higher move when it comes to prices. We're kind of like nibbling at that area right now, but we don't have a full-on confirmed export boost that's taking place for right now. We did see some optimism when it came to soybeans, but it's still not as aggressive as we compare this time to last year as well. So be mindful of that. I want to kind of transition here. When you're looking at soybeans and corn, we are entering into a period of harvesting, and I believe we're at 20% when you're looking at corn harvest so far this year. There is concern that it's not going to be as robust as maybe the expectations have labeled so far, but we are still very early in the process. And so exports for soybeans has increased. China has picked up that demand. But once again, we want to see really confirmed follow through, and you will have hedge pressure taking place literally throughout October, and then pretty much probably the 1st of November. And then those hedges are going to start rolling off once you get to that closer and closer to that December contract. What do we mean by that? When you are hedging as a producer, you have physical crop and you want to be able to lock in prices for your existing crop that you have right now, and then what new crop we're going to bring on next year. And so we will see a lot of producers actually shorting these contracts to be able to lock in prices and hedge themselves. And then once they are able to get done with that harvest, once they know exactly what they have pretty much in their inventory or what they produced, then they're able to unwind those hedges in order to, realize prices. So that's what's going to be happening right now. I would not suspect a massive run up in soybeans. I would not expect a massive run up in corn right now, just because you will have that mechanical structure of producers basically fading your moves right now. And that's not going to be something that's outside of the norm. That's a normalized thing. What could happen though, once we get closer and closer to December and we start focusing on other contracts, and you start looking at what the March contracts of next year, that's where you could actually see that boost pushing higher. And then that also will have that weather trade or that weather premium kind of being built in. You're also looking at forecasts moving forward. So that's kind of what I'm looking at when it comes to the grain complex. It looks like we have found a near-term bottom, but the springboard move to the upside from a fundamental standpoint has just not hit quite yet. We still have another couple of weeks left to go.
No, that's perfect. And Sam, we had a question here, and for me looking at the chart too, I do want to ask you this question, which is, what do you like about SCCO over FCX?
Well, you can just look at a ratio chart of the two. You have SCCO making new multi-year highs, it looks like, relative to FCX. So that's how I would look at that. I mean, they're very similar stocks in that they both have a lot of copper exposure. However, it seems like SCCO is the preferred vehicle. And it's very liquid as well, so you can trade options on it. Yeah, I love it.
Yeah, I'm trying to figure out the ratio chart on TrendSpider. Oh, there we go. Okay, I always use stock charts for my ratio charts, but is this the one you're looking at, Sam?
I can't see your screen.
You should be able to.
Oh, there you go. Yeah.
I'm just kidding. I stream live into Sam's life. So when we're looking at this ratio chart, this is FCX to Southern Copper. Yeah.
You have this backwards.
But you wanted SCCO to FCX?
Yeah.
Okay.
There you go. So as it goes up, SCCO is outperforming FCX, and
yeah, the relative
that
strength
seems to be the trend.
Yes.
The line go up.
Yes, the relative strength is high, and that's interesting because in the past it's been the opposite. Since 2020, now seeing that going the other direction. But look at the bull markets that happened very quickly in some of the commodities. Like this is 2014. See this massive outperformance in SCCO, which kind of continued to just kind of trend sideways to higher going into 2020. Then it fell off a cliff. But there was a bunch of hype around FCX at that time, if I remember correctly. I can't remember what exactly it was. Do either of you guys?
No, I don't.
Yeah, I can't remember what the hype was about FCX at that time, but I know Southern Copper is usually the outperformer. It's got a little bit more alpha, so good chart, Sam. Good idea.
Yeah.
So Kevin, got to talk big picture here. Oil, energy.
I wrote about this on Friday. Just Kevin, heating oil, gasoline, crude oil, all at huge levels of polarity. this really is a inflection point. Like the Bulls need to defend this level. I know you guys were talking with Josh Young several weeks ago, and he doesn't really expect it to break down here. He's an energy bull. Where do you guys stand on that? Because these charts look pretty vulnerable to me.
Um, well, oil's been vulnerable for a while. Okay, so let's kind of break it down. So oil has hit an area of support. We've had some buyers kind of stepping in. I think that's the effect of short sellers or shorts in the market kind of covering for now. Looking at that optimism when it comes to the Fed, maybe that's going to have an impact on demand. I'm not a huge buyer of that, honestly. Like I would rather look at 8 other different fundamental catalysts and thesis for oil rather than Fed rate cuts. And if you wanted that type of proxy, probably looking more towards like a metal, a silver, or a copper probably would be that direct play. For oil, what we're going to see is refine rates or run rates starting to creep to the downside on a seasonal basis. That should actually tighten up supply. We still have weakness when it comes to China demand. In the China story, I'll completely be blunt with you guys. It's a lot worse than what they kind of put out there. And I think we're kind of coming to that realization right now. Now they will have some commentary. It sounds like they're going to do like a press conference tomorrow, but I think everybody kind of expected that China would be able to hold their own for the most part. I think it's been a little bit worse than expected. So we did see that slide. Oil is still in a downtrend, but once again, kind of having that hammer candle on the weekly chart on the week of the 9th for September and trying to bounce off of that. There might be a little bit of geopolitical risk premium that gets built into. Lebanon's not a huge producer on a global scale for oil, but you think about what this could actually transpire into from the Lebanon-Israel situation. And if we do get Iran involved, then that could obviously put a little bit more of a risk premium that's in place. You kind of have that chart up there. I get concerned about this breakdown, and any further breakdown, in my opinion, would be the result or the reflection of global slowing when it comes to demand, because from a supply standpoint, there's nothing that's like outside of the norm. I mean, in fact, you're actually still seeing rig counts kind of come in or being pulled in here a little bit, and production levels for the most part are stabilized. So
what would crude oil breaking down here mean to you from a more macro standpoint? I
think that would,
the world's going to hell.
Well, the world's never going to hell, man. I mean, like the world is going to be what it is. The breakdown of that 200-day or 200-week moving average, we're going into the 7th week of that. 1, 2, 3, 4, 5, 6, 7. We're going into the 8th week of that. Usually, if you kind of coincide the breakdown of that 200-week, once we get to that 8th week, it does kind of signify that we have global slowing that does take place. Now, that's just a technical look at it compared to what we've seen in the past. And generally, you would see that coincide with pullbacks when it comes to the equity market as a whole. Now, we're cutting. Obviously, that's going to be a fundamental catalyst for equity prices or valuations to move higher for now. But any type of further breakdown, and for me, that would be testing that $60 level. Anything below 60 for me is a very big cause of concern. I'm already concerned, but it would be more of a cause of concern right now. And that's why I kind of go back to the China story here. I believe that and it's not out of the realm of possibility. We've seen this in the past, but I believe that their economic data is actually a lot worse than what they are actually printing, for it to really kind of coincide with what we are seeing from the energy market. Now, if I'm not even mistaken, and I'll get the report up, I mean, even if you're looking at the imports from last month, very soft. Imports, when you're looking at India, fairly soft. So I don't think that we can deny that you are seeing a little bit of a slowing when it comes to demand. I think right now it's just the market coming to that realization and actually having that reflected with the fundamental data. It just hasn't been there. Gasoline, I actually kind of like this bounce, and this is where I get a little bit, obviously it's a byproduct of oil, but I believe that the byproducts actually push the general trend for oil prices usually, right? So if we start seeing demand stabilizing when it comes to gasoline, then that should actually stabilize those prices, and then maybe that translates into crude. This is the chart that I feel like the Fed has a problem, a very big problem. Okay, so this is kind of my area or line in the sand. You got a former resistance now turning into support. let's say we break that support area.
This one has heating oil and crude oil have not, but RBOB is the one that has broken below, and it seems to
Yeah,
be scooping back above pretty quickly and maybe
Very
triggering a potential failed breakdown signal. But this one
yeah,
looks the worst of the three.
it does. I will say though, I give a little bit more leniency to price breakdowns for trends during seasonally weak periods regardless, right? Because that's what you're showing as a continuation chart. So sometimes we can see us testing a certain area, but it's in a very strong seasonal period like in June. That's more concerning to me than us actually breaking down in let's call this basically October prices, right? And that's where we usually see slowing. But I'm right there with you. I mean, if you look at this chart, it's hinging lower. It seems like it wants to break. The problem that the Fed has with this, and why I would say, what is the risk reward? Breakdown or a breakout or recapturing, right? If we break down once again, for me, economic slowing, I don't know if the equity market even cares anymore. Equity market's kind of telling it its own story, and people are, you know, rah-rahing over certain things, and I don't think that they should, but whatever. They're going to do their own thing. But let's just say that we do bottom here in a seasonally weak period for gasoline. The Federal Reserve is going to be pretty screwed. They actually probably could be already screwed in a sense here. Now we have to see it actually being reflected in retail gasoline prices, which we haven't seen that dramatic of a drop compared to what we have seen from the futures. But just for conversation for today, let's look at a weekly chart. From the lows of 185 to what we saw pretty much the peak just for this week alone, and we've only been trading for less than 24 hours, we are already up 10%. Right? That's going to be a problem if we do see this actually as a bottoming formation. And let's say that we go back and test that 20-period moving average for gasoline, which is still below the 200-period moving average. That would literally sit at around what, 233. So let's look at those lows that we had earlier in September to hitting 233. You're talking about a 25% increase in prices. Tell me how that's going to impact CPI and PPI. So the Fed's kind of in a rock and a hard place, and I understand that people want to like rah. Oh yeah, look, I mean, if you X out shelter, you X out the price of sweethearts, you X out the price of lean hogs, and if you X out the price of heating your house, X out everything that you can, X out insurance, all that stuff. We're sitting at 1.9%. We're hitting the target. That's BS. That's not how any of that stuff works. And unfortunately, this is exactly to the T what Jason and I were calling out last year at this particular time. This will be a problem. So I either say you break down and prices continue to break down, and then you get your slowing indicator, because it will be a slowing indicator, or you don't and we get a bottoming. Risk reward. That's how I look at it. I feel like it's a 50-50 shot. And either way, I think the Fed is screwed. Gasoline should still slide, Sam. If you're asking that question, should it slide? Yes, technically it should. But if it doesn't, and if it's already oversold, and we already have a significant amount of shorts in this contract, right? And if this actually is the bottom, the Fed is going to be in a very bad spot. And that's my thing when you're looking at RBOB. Heating oil, and I'll end at this. Heating oil actually seasonally should be the strongest byproduct of energy from now till February. Seasonally, so heating oil and diesel, we have them interchangeably. But when we actually talk about heating oil itself, which is 95% of the same type of components that diesel is, there's a small little difference. Heating oil is actually used in the Northeast for boilers to be able to heat homes and pretty much factories, not really homes anymore, but to heat factories in the Northeast, right? That's still being used. So there should be a seasonal demand factor that's there. Heating oil is just showing you that the transportation sector itself is in a recession. Industrial transportation is in a recession for sure. But once again, can we go down even lower? Yeah, we could. But what if we don't? Right? Yeah. What if we don't? the retracement of some of these price levels would be very aggressive when you're looking at consumer prices. If you're going from 213 right now to the 20 period moving average on the weekly chart, which is sitting at 236, okay? Just the 20 period moving average, you're still below the 200 period, which is what I focus on. Just the 20 period moving average alone, you're talking about a 10% increase. If we go to the 200 period moving average, which is sitting at $2.70, you're talking about a 27% increase from these current levels. And I know math is hard for some, but it is not for me. You better hope that these prices just stabilize and consolidate literally for the next 3 months to 4 months. If not, you got a problem and the Fed's going to have a problem, just like they did last year. And the similarity right now is eerie, very eerie. So that's my 2 cents of the whole thing. The prices are going to do what the prices are going to do. Would I say take a shot right now? I don't know. And if we're going to take a shot, technically, I'm not giving a call here. If you were going to take a shot, I think heating oil would be the one to take because it has that seasonal demand factor. And you'll start seeing a closer correlation to heating oil and natural gas in the wintertime than you will mostly for heating oil and crude, because of the heating factor and the applications that is used for in the winter months. Sorry, I'll kick back.
No, that's perfect. And I think something that's, like you said, we've been talking about this for a while. And anybody who knows me knows I say the same damn thing every single time, which is the Fed is always behind the curve. Think of transitory inflation, like we're basically people like Kevin and I and Sam, we're looking at the commodities every single day. We're watching all the commodities go up in price every single day while the Fed's going, inflation is transitory. It doesn't really exist. That's what they do. And so now we're at the other end of that, where they're going, we won the war on inflation, it's done. And they're going to start lowering rates. And Kevin, Sam, and I can see right under the surface, like, hey, there is inflation here. It's right under the surface. And anybody who lives in the real world, like, they also see inflation. So it's very interesting to kind of see what's going on.
Yeah.
So,
can you guys see my screen here?
Yeah.
I wanted to get your thoughts on this chart, Kevin. I thought this is Jason was talking about this at our portfolio accelerator. I just think this is the chart. Like, this is the best chart in the world right now.
Yeah, it's easy to make sense of. And I think for me, the reason why I bring it up or brought it up at the event was to show when we're looking at the Fed and people go, okay, the Fed is lowering rates, which means we won on the war on inflation. You have to see sometimes the Fed is a little bit behind the curve. Sometimes they make mistakes. Like sometimes inflation is dropping, sure, but sometimes them dropping rates can trigger inflation up higher. So what do you think about this, Kevin?
I think this is a really good chart. What I will say though, month over month is what really matters, and that's what's going to screw the Fed in the near term. Year over year comps are going to be, for the most part, favorable for them probably until about February of next year. Actually, March of next year. I think the March, and when I say March of next year, let me clarify, the March data set, right? And that's where we kind of see, some of these deflationary pressures that took place this year, right? The January print was hot. February print was hot. March was, for the most part, hot. And then we started getting those deflationary prints. When I kind of look at this chart, we have to also be mindful of the seasonality changes and the readjustments. So that's also a really big factor. And then also the calculation. But what I look at is that month over month number, and just knowing that the 3 month annualized is really what the Fed looks at. So let me just do this quick exercise here real quick, just so I can provide a little bit of color for individuals. So if you watch this all the time, I talk about 200 period moving averages, right? And that being a key area of support or resistance. And it's going to tie back into this chart here, because if you think the Fed late right now, that might be the case. I say it this way. It's not early or late. They're stuck, right? It's not early or late. They're stuck in a rock and a hard place, because either one of two things are going to happen here. And it don't look like it's going to be, if you're looking at the GDP numbers, it doesn't look like for now we have an economic slowing. The GDP numbers are very distorted though, guys. A lot of that push is inventory build And just because you have a buildup in inventory does not mean that you actually have positive consumption of that inventory. So be mindful of that. Two, when you're looking at the Western ports, they are literally working at capacity right now. And why are they doing that? Why are you seeing such an influx of products moving into the United States right now, especially on the West Coast? Tariff policy. This is nothing that's new. This has been going on for the last 6 months. So I feel like when we talk about GDP, yeah, they look really high, but there's an inventory component that's really big. Okay, so let me just do a little quick exercise for people. So people are like, KG, why are you freaking out? So food inflation has been, for the most part, decelerating, and actually it was a deflator for a very, very long time, right? And we talk about these commodities all the time. So let's look at wheat. Wheat's not probably a huge component when you're looking at what we consume, but wheat is a big driver for feedstock. So is corn for feedstock, right? So what we give to our cows, what we give to our pigs and things of that nature. 200 period moving average, from current price levels to the 200 period moving average. Right now, you're looking at around what? Let me get this moved up here. Of course, my chart doesn't really work today. You're looking at what, 20% for wheat? I'm gonna get this chart up real quick. And I think this is the reason why it's important. Oh man, 18%. Chart of wheat. If we have the current price of wheat to its 200-week moving average, that would be around an 18% adjustment. You don't even have to pull it up. I'm just going to go real quick here. Corn, which is going to be an ethanol component as well as a feedstock component for cattle. From right now, current levels to right now, from current levels right now, going up to the 200 period moving average, price adjustment right there. 26% increase in prices, just from a technical retracement standpoint, if I can put it to you guys. What else? Soybeans. Soybeans right now, current price level to the 200 period moving average, 24%. Huge when you're looking at feedstock. If you're looking at, once again, gasoline, where are we at? $1.98 right here. Move that up to the 200 period moving average. You kind of get my point. 21%. You feel me? So do we see prices stabilizing at these levels and demand staying strong that everybody believes, or do we have a problem? And that's where I'm coming from. And I think there's a risk reward on both sides. And you could actually probably pairs trade this thing up. Like Wednesday of last week, I was talking about an example. This wasn't a recommendation, but an example that you could have pulled off here on that Fed meeting. What was going to be the move? Who knows? Could have been a sell the news or buy the rumor type of event. But what you could have done is bought small cap, IWM calls, and you could have also bought TLT, because one of the two are going to be able to move. And the small cap side is going to be a little bit more higher beta. But if you had a failure, you would have that reversal move to the downside when it comes to TLT. And actually, they both panned out. Mm-hmm. You could pairs trade the same thing here. And that's kind of how I look at it. So yeah, Fed's in a rock and a hard place. That's what I think about that. You want to talk about the uranium here real quick because everybody's talking about it.
Yeah, go ahead. We'll end on that. We got 5 minutes, I think.
Yeah, I know. I'm sorry. I wish I was here a little longer. All right. So look, I wrote a thing last week, and I swear to God, I did not know that this whole Microsoft thing was going to literally drop like 20 minutes after I wrote this thing. But it's all good. It's all good. The uranium trade, there's two parts of this. One is going to be supply disruptions, and that's my biggest thing about this. You have the AI narrative, put that aside. Put AI to the side. We know that there's electricity demand. Yes, it's going to be a thing there. Put it aside. Think about just the supply and logistics that are taking place right now. We saw a scenario in July of last year in Niger where France and the Western countries had a pretty big stake in uranium production and mining there. And France actually has one of the bigger productions infrastructures that are in place to be able to enrich this uranium, things of that nature. Now we had a coup that took place. We actually had the support of Wagner forces from Russia, also helping out these the rebels there at that point in time. And we saw pretty much an ouster of Western influence when it comes to Niger. And now Niger is top 4, 5 when it comes to uranium production. So you took off a little bit of a, an area there when it comes to supply. So you have this little rerouting taking place. Now, Russia is the biggest exporter of enriched uranium, and we're a huge importer of that coming from Russia. There's not that many places that you can get. But Russia's Vladimir Putin, about a week ago or 2 weeks ago, said, hey, we could actually curb the export of certain commodities to these Western countries, not just because of what's happening in the Russia-Ukraine conflict, but also because of U.S. economic sanctions or EU economic sanctions on the country. That will be a problem. Now, that was going to also be a problem for Russian companies, too, because they're a huge exporter when it comes to pretty much any natural resource that's out there. But that would be a problem for their own businesses. Now, I called that piece, mutually assured disruption, right? They're both going to get screwed. But you could actually have a squeeze of physical uranium supplies over the longer term time frame. And that's where companies like the CCJ could actually benefit, right? They have exposure in Canada. They have exposure in Kazakhstan, if I'm not mistaken. They have exposure in certain areas of the market to be able to try to backfill. But I think even a slowing of exports from Russia in this space, just to kind of put a little bit of pressure on the West, could actually have a dramatic impact. And when you're looking at electricity production, 20% of that is coming from nuclear power, right? And so there's a longer term time frame there. I think there's both sides of the aisle right now have warmed up to it. I mean, conservatives have always been on board. Liberals are now kind of getting more on board. And I think that's probably going to be a tailwind for a lot of players out there. Last thing I will note, for CCJ, weekly chart, MACD trying to cross 12 EMA above the 26, still under that zero line there, so still ultimately bearish, but the first initial bullish cross there could be something to be mindful of. Stochastic already crossed, looks like that wants to make a little bit of a move. CCI making higher lows on a relative basis. That is also an area. The 20 period moving average for that weekly chart is going to be your area of resistance. That's literally what we're testing out right now. We could see a further breakout to the upside when you're looking at URA. I may have said CCJ, but URA, that's what I'm looking at there. CCJ is another proxy. There's also this setup too. There's not a lot of players that institutions really trust. Right. So you can have this concentration of flows that has like a rising tides lift all boats type of scenario taking place. So yeah, be mindful of that. I think everybody's kind of on that train now, but I think this is a longer term time frame, outlook or view.
No, I totally agree with that. Like these are like you look at CCJ, this is like a multi-decade base. Like these are long-term trends that haven't even broken out yet. That's a great point.
Giant. So
make it less ugly. But
it's like
it's a huge
it could take some time to resolve here, but I think ultimately it resolves higher and breaks out to all-time highs. And maybe this is like, in my mind, a decade-long trend.
Yeah, I mean, if we break that level, if we get above, 52, get a close above there, man, that thing could take off. Also, a shameless plug by me. There's my call options. We bought the 170s.
Hell yeah, Jason.
Ago. And like Kevin said, he didn't know it was going to happen. I totally knew it was going to happen. I can't believe Kevin.
Yeah.
I'm just kidding. I had no idea.
Jason has a crystal ball.
Yeah.
No, I hate that. I hate when I write something and then it becomes like, it's like the news headline of the day. And it's like, dude, now I look like I'm just like a follower. It's like, I think about these things now, but good rip on that, man. And I mean, you've been killing it lately. So, by all means, continue to run with it.
Yeah, I mean, I got to do a shameless plug once in a while, but I also want to say, just like you said, it's not something you look for those high probability setups. You put them together the best way you can. We use call options to take advantage of it. Like they were very cheap at the time, underpriced, made a huge move. And that happens sometimes, but it's not something where you ever know the future, whether most things or not. But want to thank you guys for coming on. Sam, thanks for coming on last minute. Much appreciated. Lots of fun hanging out with you this week in Chicago. I'll see you in like 30 minutes on Gold Rush Report.
Yeah.
And then Kevin.
Chicago was awesome, Jason.
Chicago was amazing. Yeah. I was bummed. Like Kevin. So here's the crazy thing, Sam. Kevin was there and we were talking about the commodity report last Monday. And I was like, hey, Kevin, what's up? He's like, I'm in Chicago. I was like, damn it.
Yeah.
I
Yeah,
was
you
like,
guys got there when I was like flying out. I believe.
yeah, it's crazy. It was
It would have
just
been
like,
great to meet you, Kevin.
yeah.
One
Next
day.
time.
I mean, we got
One
to
day.
get something together. We got to get something together. Yeah, if you guys have like those big conferences or whatever.
Yeah, come to Miami in January.
That
That's
would be one
amazing.
to maybe figure out a way to get you as a speaker or something, or like, cause that be we had some speakers come in, and I was like, we got to talk also off mic. There's people who are big fans of Kevin also over there, so
Oh man.
You're kind of a big deal, Kevin.
you're kind
Oh no, I'm not.
of
The way, hey guys, I really do appreciate you. And then Jason, if you're trying to connect later this week or what have you for another thing, I mean, people can put it in the comments too, because I kind of do feel bad that I was a little bit off my game and back and forth too. If people want to get another like quick hit, by all means, or if you are you doing your macro Friday?
yeah. Come
Okay.
on if you can.
Yeah, I'll probably join on on Friday. But I do gotta jump. I hope you guys all have a good rest of your day. I'm glad that we're kind of getting these things back up and running, and hopefully I don't have any more scheduling disruptions.
All right, guys. I'll see you.
So,
All right, bye. Later, Sam. I'll see you
See ya.
in a few.